I'm going to talk to you a little bit about NPV and IRR, net present value, and internal rate of return. So NPV, we're going to do a calculation here, and so we're going to set it up as costs going out. Costs going out are going to be money that we have spent for the project. So I'm just going to put in, say, $500 going out. This is time 0, and then we have times 1, 2, 3. How many do we need here? Let's just do 4. So we have time 4, and we'll just go 100, 125, 150, and 200. That's probably not going to do it. Let's do time 5, 250. Okay, so $500 out at time 0, 100, 125, 150, 200, 250 coming in. If these were all the same number, if they were all 100, we could do this on a calculator. It'd be very simple to do, but because it's not very simple to do, this is money going out, this is money coming in, and all these numbers are different. We're going to do it on a spreadsheet. So we're looking for net present value. So we just simply do a net present value calculation, and we hit the equals button, and we hit NPV, parentheses, and it asks for a rate. Now, we like rates as a variable, so we want to put those as separate. So I'm going to escape out of this, and I'm going to go rate up here, and I'm going to put 0.08, and we have 8. I'm going to turn that into percent so I know what I'm doing. And then I go over here, it says equals NPV, parentheses, rate is going to refer to that cell, comma, and then I'm going to window in. Now, here's the important thing. I'm going to window in the cash flows, not the existing first payment that I paid for the project. It's just the cash flows after time 0. So I'm going to window all those in. Notice I have omitted the 500. That is not included. In parentheses, enter. So this cash flow, discounted back at $635, would compound at 8%. So you could put this into compounding terms. If I deposit $635 today, I will get 100, 125, 150, 200, and 250 as withdrawals at 8%. Now, the flip side of that, of course, now we're going to do net present value. So this isn't actually the whole net present value. This is just a compound question of how much, or a present value question of what the present value is for this cash flow stream. To get the net present value, we then subtract the first payment from this, the initial cost. So we would have 635 in our bank today. If we deposit that, we can withdraw this, and this, and this, and this, and this. But we don't have 635 that we're putting in our bank. What we're actually doing is depositing or investing $500. So that's a different amount. So we take the 635 and we simply subtract the initial investment and hit enter. And we have a net present value of $135 for this project. That's positive. We like positive net present values. Now, the reason we call it a net present value instead of a present value is because we're omitting or taking away, we're netting the initial investment. The initial investment here of $500 is we paid $500, or if it was a larger business, let's say we paid $500,000, and the first year we earned $100,000, earned 125, earned 150, and so on. That would be a significant investment. So we bought a building, we started a company, whatever we did, we put $500,000 in, and this was our cash stream out, discounted back at 8%. So clearly we could have different discount rates. But what this really says is, if I invest my $500 in this project, and I expect these cash flows in return, I will get a return of not just 8%, I will get more than that. In fact, I will get my 8% return plus $135. So I'll get 8% plus $135 if I invest $500 on this project. Now, another way to look at this, which is a more common way, is instead of investing my $500 and getting 8% and $135, I borrow $500 at 8% interest. These cash flow payments pay that interest. So I'm paying interest at 8%, and that's gone, and I'm left over with $135.99. So I've paid my interest expenses, and I'm remaining with $135.99. So this is a positive project for me. I borrow 500, I make 135, and I don't have to do anything else. All I have to do is invest it here. So that's a very positive project. Now the other way to look at it is, what if I just put up all the money myself? What would my rate of return be up here? Well, the easy way to do that is to do IRR. I'm going to put NPV. I'm going to put it over here. I'm going to put IRR over here. And now we do a simple IRR calculation. Now, here's the thing. The IRR calculation needs one of these numbers to be negative. And the minute I change this number to be negative, it changes. Oops, excuse me. Negative. It changes this calculation to make it positive. So what we're going to do is we're going to leave that negative. We're going to go back to the NPV calculation. Instead of subtracting it, which is what we're really doing, we're going to add it. And so we added a negative number. It comes back correctly. But now you see this is $500 going out. So what we do here with the IRR is to simply do equals IRR, parentheses, and it just says values and a guess. You don't have to put in a guess. Just put in the values. Here's your values. Window it in, parentheses, enter. 16%. So if this were the case, if this was your project, we could have 8% and have 135 left over if we were borrowing 8%. Or if we just funded the whole thing, the $400 or $500 came from us and we didn't have a discount rate, if you discount all this cash flow back, you would get 16% return on your money. So if you just took this away, you would end up with 16% on your initial investment of $500, which is a pretty good return on your money. That's certainly something that's positive. So in both these cases, this would be a positive outcome. The calculations are really straightforward. IRR equals window them in. In NPV, you window in only the positive cash flows, and then you add the negative at the end. Now you can subtract it if you want to have a positive here, or you can do what I did, which is change it to a positive, so you can do the IRR calculation at the same time. Either way, you end up with a fairly easy answer to come up with. The math isn't very difficult. Somewhat challenging, more challenging, is the ability to put it into words. So one way to put it into words is if I invest $500 today at time 0, and I receive 100, 125, 150, 200, and 250 every year after that, I will have a net present value of $135.99. So that is a positive gain for me or my company. And if we haven't borrowed at 8% in our discount rate, then we could have an internal rate of return of 16% overall in this project. So if we fund the whole project ourselves, then this would be our rate of return. If we use an 8% discount rate, then we would get a return of $135 on top of covering our expenses, our borrowing here. So either way you look at it, this is a positive project. Putting it into words is somewhat more difficult. It's a little more challenging. We will cover IRR and NPV more in lectures coming up, but I want you to get a little practice with the spreadsheets so you keep your spreadsheet skills fine-tuned, because it's very important for our next lecture. This is an example. I don't want to go too far into the next one, but this is an example of, say, company cash flow going forward, and if you discount this back, what would the stock price be? So that's what we're going to work towards after that. But for now, I'm going to give you a couple problems on just simple NPV and IRR to be able to get you to do these calculations, and then we'll keep going on that. So stay tuned. Thanks so much.